I'm sure there's plenty of people who are a bit older, they've got a lot of money, but they're not billionaires, but they're a bit worried maybe they've got numerous siblings or numerous children, and they think, do I really trust any one individual?
I mean, a lot of times it doesn't even necessarily have to do with the trust aspect, although that certainly is a consideration, but sometimes it also just has to do with the fact that, many wealthy kids have been fortunate in that they've grown up wealthy, and so they've really been able to choose to study or focus on the things that they're passionate about rather than making money, right?
So this is the Adam Fard Show for Expat Wealth. I'm delighted to be joined by Jimmy Sexton today. How are you doing, Jimmy?
Doing well, Adam. Thanks for having me on.
Well, it's a pleasure. And Jimmy, I'm curious then, what led to you being where you are today? You must have not just obviously came overseas, for the sake of it, right? So what's been your journey up until this point?
Well, I mean, I was fortunate. So I grew up between between California, Austria, and Germany. So I always sort of spent half my time in the U.S., half my time in Europe. So I sort of grew up living internationally, and so I started my company Esquire Group in the U.S. In the early 2000s, and about 2010, right when FATCA was coming into play, I started branching off into Europe, because obviously there was a lot of Europeans or Americans living in Europe, especially accidental Americans, that were looking for information on how to get into compliance and how to deal with FATCA. And so I opened up an office in Vienna and was working with Americans throughout Europe, giving a lot of presentations to American groups throughout Europe on the impact of FATCA and how to deal with it. And then in 2013, I got my first client in the Middle East and started spending a little bit of time in the Middle East. And at that point, I was sort of looking at renouncing my U.S. citizenship and wondering where I was going to go. And in 2014, I got introduced to Dubai for the first time and just absolutely loved it. And moved here in 2015, and I've been here ever since. And one of the best decisions I've made in my life.
Yeah, I think a lot of people say that, right? When they go overseas, obviously it doesn't work for everybody, but many people say it was one of their best decisions, right? So interestingly, the Austria side, was that because of like a family background, or just you enjoyed it kind of?
Sort of. So my mom's actually German. But my family really liked Austria. Okay. And so that's where Austria came into the picture. And so since I went to school there and had friends there, and I'd spent quite a bit of time there throughout my life, when it came time to start doing business and spending more time in Europe to build my business there, Vienna just made a lot of sense for me.
Sure. And it's interesting, you mentioned, say, FATCA, which obviously caused a lot of issues for Americans living overseas. In very simple terms, how would you explain FATCA for, say, an American who's about to go overseas?
Well, I think FATCA has many different implications, but I think in terms of an American that's about to go overseas, the main implication of FATCA is that FATCA requires foreign banks and other financial institutions to report the accounts of U.S. persons, so citizens, green card holders, to the United States. And so, basically, if you have an American that moves overseas and let's say they're living in Austria and they have a bank account there, the Austrian banks are going to report that information through the Austrian government to the IRS.
And what's interesting about this rule was I noticed when it first came in, and I was living in Southeast Asia at the time, many banks, insurance companies, and other financial institutions just refused to take Americans any longer because they thought this is too much hassle, right? Not all of them, but a lot of Americans, I think, got debanked, or their platforms or brokerage accounts just said, we don't want to deal with you anymore. But fortunately, there are companies that do accept Americans, but it's much fewer than before this rule, I think.
Well, I think my experience has been maybe a little bit different. I think my experience has been, I think, as you very correctly state, as FATCA first came out, most, or not most, but a lot of banks just decided we're not doing business with Americans. This is done, right? I think what I've seen happen over the years, though, is that most banks now that FATCA's kind of settled and there's people out there that really understand it, I feel like the banks feel like there's a little bit more certainty around it, and so I think most banks will now accept American clients if the American is resident in the country where they're trying to open up a bank account. So if you use Singapore, for example, I think if an American now just tries to go open a bank account in Singapore, probably not going to work. But if the American is resident in Singapore, then probably they're going to get an account. I mean, what I've seen is that I think you still have a lot of sort of private banks and wealth management banks that very much do stay away from Americans,
Yes.
or companies offering brokerage account services. But I think most banks just offering normal banking solutions, I think most of those banks will accept American clients again now, assuming the American's resident in that country.
Absolutely. As you said, I think as well, when it comes to a brokerage investment account, it's much more likely that the institutions didn't accept Americans.
Yep.
But we have noticed ourselves now in the last few years doing what we do in the expat investing space, that more companies are kind of allowing Americans again, I think. But as you say, maybe it's because now the dust has settled a bit. They understand what the rules are. They understand the costs and so on and so forth. But it definitely has added a layer of complexity, hasn't it? Like the PFIC rules as well.
Yeah, I mean, it's also added a layer of cost, right? Because I mean, if you, as a non-American, using like a Swiss private bank as an example, go to a Swiss private bank, you can do business directly with the Swiss private bank. But if you're an American, you're going to need a registered investment advisor, sort of to act in between the bank and the U.S. person. So it adds a layer of complexity and also a layer of cost.
Absolutely. Now, we just mentioned the PFIC rules as well, right? And a lot of people also get confused about the rule.
Yep.
But my understanding is it can be explained in quite a non-complex way as well. What would you say in kind of broad terms are the PFIC rules? Now, of course, this is not formal tax or legal advice and so on, but what would you say are the basics of it?
I mean, look, so PFIC is generally any sort of foreign company that's generating mostly passive income, right? So interest, dividends, royalties, things like that, right? So the technical definition is a foreign company who, I think there's more than 75% of its income is passive, so interest, dividends, things like that, or more than 50% of its assets produce or are held for the production of passive income. And that's something where people get tripped up quite a bit, right? Is if you have a company that's actually, let's say at the moment, not generating any income, but it's sitting on a large amount of cash is held potentially for the production of passive income. So it would be a PFIC just by virtue of it having a lot of cash and no other income. But the main downside, so I mean, when you think about PFICs, I mean, the easiest way and the most common way to think about a PFIC, if you're investing in some sort of a non-US fund, a mutual fund, any kind of investment fund, that's generally going to be a PFIC. And the downside to a PFIC is when you sell it, and most kinds of distributions, which they define as excess distributions, but if you receive a distribution from a PFIC or if you sell a PFIC, you're generally going to have a punitive tax, which is essentially you have to take the gain or the distribution and divide it up over the holding period that you've had it, and then calculate the tax. Like, so let's say you owned it for 5 years, right? You'd have to calculate tax on the gain in each one of those 5 years at the highest tax rate then in effect, and then apply an interest charge to it as if you should have, because you didn't pay the tax in those years. And by the time you add up all that tax and those interest charges, I mean, oftentimes what you wind up owing will wipe out any of the gain or distribution that you receive.
And if I'm not mistaken, in general terms, if an American, still holds their nationality or they've got a green card for that matter, what you just said means that often it makes sense to still own ETFs and funds domiciled on the New York Stock Exchange. However, secondly, if it's an individual stock or an individual corporate bond, I believe in general, then the PFIC rules don't exist. Is that correct in general?
That's correct. In terms of assuming that individual stock is a company conducting active business, right? Like you own a stock of Mercedes or something like that, where it's an active business, then absolutely. I would say generally that's a correct statement.
Yeah, it's interesting because we're talking to an American today actually and just explaining, well, if you want to buy a foreign ETF, we can technically mirror the index and so on with individual stocks. And, it's interesting how a lot of these rules to the average layman who's not in the financial services industry don't make sense, but it is what it is, right? It's just these tax things can trip you up, right? Because as you said, in some cases, I think the PFIC rules can cost you 30 or 40% pretty much, right?
Well, and I mean, it's not. I mean, absolutely right, and it's not just the tax cost to the PFIC rules either, right? I mean, it's the reporting that you have to do on the PFIC, right? I mean, you have to file Form 8621 if certain criteria are met, and this is something that a lot of people miss, not because they intend to, but because their tax preparer doesn't know what they're doing, because they're not specialized enough. Or they forget to tell their tax preparer that they own this because they don't realize that this needs to be filed. And obviously, besides the penalties for not filing Form 8621, 8621 is one of those forms that will cause the statute of limitations on the tax return to stay open indefinitely, which means, the IRS can come back and audit the tax return 20 years later. Owning PFICs does carry, some financial consequences, negative consequences, as well as some risks associated with the compliance aspect of it.
Sure. Now, circling back to what you do, obviously part of what you do is the tax side for assets, presumably, but
Yep.
I believe you also help business owners who are Americans who may be living in wherever, Dubai or Singapore,
Yep.
Qatar, whatever. So when it comes to, let's say, your American clients, what would you say are like their key 2 or 3 reasons why they reach out to you, and how do you help them in that respect?
So I would say there's probably key 3. So, my background is in U.S. international tax. So, helping Americans navigate the U.S., the international tax landscape when they're doing business or investing abroad. So I think, one of the reasons people reach out to me is they believe or realize that they have a tax problem, that maybe they haven't been reporting everything properly. Maybe they know they haven't been reporting everything properly and they want to know how they can get back into compliance. Now, I don't do the returns myself, but I can certainly advise them and help them, devise a strategy for getting back into compliance and then put them in touch with the people that can actually prepare the returns. The second one is, Americans doing business abroad, right? So Americans, we have several here in the UAE, or as you mentioned, in Singapore or in Europe, that own a business, and they want to know the best way to structure that, right? Should they be structuring that as a sole proprietorship, as a corporation, as a partnership? What are the tax consequences of the different ways of structuring, and what's going to be most advantageous to them, right? And so helping them figuring out what that structure is and which is going to be most advantageous to them from a U.S. tax standpoint, as well as a local standpoint where they're doing business. And then thirdly, I think the third reason is, I think there's a lot of mixed families where you have some people that are U.S., some people that are non-U.S. So for, as an example, a very typical situation that I run across is, a father that is not a U.S. person who's generated the wealth and made the money. You have a wife, the spouse, who's a non-U.S. person, who is a U.S. person, and because of that, the kids are U.S. persons. And then how do you do the estate planning for that, right? Because obviously the father's generated all this wealth, doesn't necessarily just want to leave it to his wife and kids and then subject it to full U.S. taxation and reporting and all of that stuff. And so a lot of, how do we structure that estate, make sure the assets are protected, make sure that the U.S. heirs get the benefit of it, but without subjecting everything to U.S. tax and reporting.
Sure. Now, this gets very complicated, of course, if it's multi-jurisdiction. So,
certainly,
and obviously everyone's situation is a bit different, right? Because it does depend on also where they're resident, I guess, and many factors, right? Yep. But I think when we were talking before, you were also saying that you also deal with non-Americans as well when it comes to estate planning, yep. Right? But I guess practically speaking, for Americans, there are other factors, right? Because for Americans, renouncing, your passport is an option. Well, it's an option for everyone globally or in most countries. But I think with the US side, it's become a bigger thing, right? It's kind of ironic that so many people want American passports globally, but then a lot of wealthy people get rid of it. Like the guy who started Facebook with Zuckerberg, Edward Swarren, I think his name is. So what about in this case? Do you help with renunciation?
Absolutely.
Who do you think should consider it as well?
Well, I think there's so we do absolutely help with renunciation, and there's, when you talk about renunciation, renunciation, we call expatriating, and there's essentially, you can be categorized one of two ways, as a non-covered expatriate or a covered expatriate. Non-covered expatriate means you can basically expatriate and you become like every other foreigner, and you have no tax consequences, no exit tax, no nothing. If you're a covered expatriate, then you're subject to an exit tax, which is basically a mark-to-market tax on your unrealized gains. And any deferred compensation items, like let's say, for example, retirement accounts, generally being subject to tax as if you received all the income in the year of expatriation. But probably the most devastating thing for covered expatriates is if they give any gifts or leave any inheritances to U.S. persons, those U.S. persons are going to be subject to the highest gift or estate tax then in effect, right? And so that makes it pretty devastating if you have a wealthy person that expatriates, but maybe their kids are still American. If they leave an inheritance to those kids, the kids, rather than the estate of the covered expatriate, are going to be liable for the estate tax. So to be considered a covered expatriate, you have to have a net worth of $2 million or more, or have paid an average income tax of, I think it's $191,000, or not be tax compliant, and that would trigger you to be a covered expatriate. So in terms of, who should consider expatriation, I think certainly accidental Americans, right, who are American because one of their parents was American or they happen to be born in the U.S. but really have no connection with the U.S. If they don't plan on keeping a connection with the U.S., if they don't plan on living in the U.S., then obviously keeping the U.S. passport is not giving them a lot of benefit, unless their other passport is not a very good passport, right? And not to call anybody out, but for example, if you have an Indian passport or a Chinese passport or some passport that's difficult to travel on, then a lot of times it makes sense to keep the U.S. passport even because of the tax, just as a travel document. But assuming you have a strong second passport, you're an accidental American and you don't ever plan on living or working in the U.S., then you're not really getting any benefit from this passport. I would strongly consider expatriating. Likewise, if you're an American that's moved abroad and you've been abroad for quite a while, you have a strong second passport, and you're never planning on moving back to the U.S. or living in the U.S., then probably the passport's not doing you a lot of good and is only causing you, downsides. I would consider expatriating.
Sure. Now, what's interesting, you mentioned about the accidental Americans. One funny case I heard about was the former UK Prime Minister Boris Johnson.
Yep.
And he was born in the United States. I'm not sure if one of his parents was American. I think they were both British, but he was born there.
Yep.
So he had a second passport, but he was furious after the IRS kind of gave him a tax bill.
Yep.
And eventually he settled it, I think, but then he renounced after settling, right?
Yep.
So I think that was one of the more high profile cases, right? But I'm sure there's been many like that, right?
I think with Boris Johnson, I think, obviously because he was a high profile person, he was sort of in the IRS's crosshairs. I think most accidental Americans never actually get in the IRS's crosshairs, right? I think most accidental Americans get into compliance for fear of the IRS, but not because the IRS has contacted them or anything like that. I mean, surprisingly enough, FATCA, as we discussed briefly, became law in 2010 and really put a lot of fear into a lot of people, including the accidental Americans, many of whom did wind up renouncing. But what's interesting is, FATCA hasn't really done anything in terms of, it was supposed to be this thing where if you didn't report and you weren't in compliance, it was going to give the IRS the information they needed to come after you. But the fact is, it seems to me and most professionals that I know that all the FATCA information has more or less gone into a black hole, and that the IRS hasn't really done much anything with it.
Well, it's a bit like the CRS at the OECD level, right? So now globally, information is shared.
Yep.
But there's so much information out there. I know obviously if AI, this could change, but you wonder what they're actually doing for this information, right? It's a bit like even when terrorist attacks happen globally, a lot of the time people say, oh, they were on the terrorist watch list or whatever. But I guess the problem with governments now is if they're collecting so much information, what do they actually do with it, right? Because if you think about it, the CRS as well, like FATCA, this is probably even quadrillions piece of information. What do they actually do with it, right? That's one thing.
We don't know, and I think what you said with AI, this could very much change. But I mean, what I've seen so far, and this is a topic that obviously I discuss with colleagues and other professionals. And I mean, what we've seen is basically they're doing nothing with it, right? I mean, it's just essentially going into a black hole. But
data collection in many cases.
Exactly.
Yeah. Well, it's interesting, but as you say, right, there is obviously a great reason why people should try to be compliant, because you mentioned about Boris Johnson being high profile, but I'm presuming when it comes to, for example, estate taxes and so on, there is an incentive for the tax authorities globally to look at those like bigger cases more carefully, because if you've got someone who dies and they've got $2 million, but then you've got another person who dies and they've got 500 million, the tax authorities surely are more likely to look more carefully at the bigger case, because then if they succeed, they're going to kind of get more revenue, right? So
100%. I mean, I definitely think, the more high profile something is, especially the more money it involves, it becomes more interesting to the tax authorities. I think the truth of the matter is, though, that, I mean, especially in terms of the IRS, I think they're so disorganized and so understaffed that I think a lot of this stuff just falls under the radar, especially on the international side, right? Because within the United States, pretty much everything that happens is there's some sort of form being filed with the IRS, right? Whether it's a 1099 or a W-2 or whatever, there's some sort of document that's going to the IRS about this transaction or about this income. And it's very easy for the IRS to track within the computer system. When a return gets filed, they can sort of match it up and see if there was something unreported. But once you start moving into income and assets that are outside of the United States, that becomes much more difficult for them.
Sure. Now, when it comes to estate planning, do you just look at it from a tax side, or do you also look at it from like a convenience side? Because, for example, if someone was to die, I'm guessing from an emotional point of view, being paid quickly, at least the beneficiary is being paid quickly, that's a massive thing, right? So, for example, some of my clients prefer to go via an insurance company because they know that the insurance company usually pays out beneficiaries more quickly than, say, an investment advisory company or a bank. So do you kind of look at those angles, or do you just look at it from a pure kind of tax point of view?
No, I look at it from a tax point of view. I look at it from also an asset protection point of view, from a privacy point of view, if that's something that's important, and also from an estate planning, as you said, sort of a convenience point of view, right? So most of the estate planning that I do involves setting up a trust or foundation, right? And so I think one of the big benefits of having a trust or foundation is once the assets are moved into a trust or foundation, they no longer belong to the individual. So you get a lot of asset protection, but you can also define how the beneficiaries are to benefit, right? And because the assets, like an investment account, for example, would be held in the name of the trust or foundation, the fact that the person died is somewhat irrelevant, because it's the trust or foundation that holds it, and the people that control the trust or foundation are the ones that decide what's going to happen with the assets in the trust or foundation. So you can still make sure that people have access, the beneficiaries have access to the money quickly. Now, one of the things that you have to consider is, how the person wanted their estate structured. Some people want their estate structured, hey, when I die, I want all the money to go to my spouse, right? And you can define that in a trust or foundation. Or, hey, when I die, I want half to go to my spouse and half to be divided up between my kids. Or you can define that, but that's at a very simple level, right? But when you start talking about larger estates, potentially, 10, 20, 30 million plus, then a lot of times this is enough money that the person doesn't want it to go directly to the beneficiaries all in one go, because they feel like it's going to be too much money and it's not going to be good for the person. And sometimes you look at it from the standpoint that there's enough money that this could support many future generations, right? In which case we want to look at a multi-generational structure where, the investments and other assets are placed into a trust or foundation, and the trustee or the board of directors of the foundation decide which beneficiaries are going to get what and when, right? So a very typical structure for large estates is you'd have a trust or foundation, and the income that's generated by the assets in the foundation would be distributed to the beneficiaries for their support, maintenance, whatever to support them. But the actual principal assets would remain in the trust or foundation essentially indefinitely. And as future generations are born, they would automatically become beneficiaries and could benefit from the income being generated within the trust or foundation. Now, obviously, they could choose distribute the principal if they wanted to, but generally they try to make it sort of a thing that's going to exist indefinitely to support multiple generations with the income, but keeping the principal within the structure, within the trust or foundation, because it's protected and will allow the future generations to benefit.
And do you ever set up structures where, for example, you set up an LLC company in conjunction with a trust? Because some of my clients have done things like Cook Islands Trust, because they say that the LLC, the company, can be owned by the trust and they can be the signatory. Have you worked on structures like that as well?
100%. I mean, that's a very typical structure, right? Because typically, whether you set it up in the Cook Islands or somewhere else, I mean, typically you would have the trust, and then a lot of times the trust would own an LLC, which would sort of be like the holding company, right, for the portfolio. And a lot of times what we do is we set up actually multiple LLCs under the trust. So maybe you have one LLC that's for owning the family's real estate. You have one LLC that's for owning the investment portfolio. You have another LLC that's for owning shares potentially in private businesses or private companies. So you sort of try to set up different silos for different asset categories.
Sure. And I guess that includes the primary business as well, because funny thing is, anyone who's watched the drama Succession, right, will know that this can be a major issue, right, for some wealthier families, not just at that billionaire level, but I'm sure there's plenty of people who are a bit older, they've got a lot of money, but they're not billionaires, but they're a bit worried maybe they've got numerous siblings or numerous children, and they think, do I really trust any one individual? So maybe the trust, we could have a board of directors, and that must also be a part of it, right?
You're 100% correct, right? And I mean, this isn't, I mean, a lot of times it doesn't even necessarily have to do with the trust aspect, although that certainly is a consideration, but sometimes it also just has to do with the fact that, many wealthy kids have been fortunate in that they've grown up wealthy, and so they've really been able to choose to study or focus on the things that they're passionate about rather than making money, right? So a lot of times you just have, let's say people that are not versed in financial type things in business, right? I mean, maybe it's an art person or something like this. And so this allows, like you said, to have a board of directors in place that has the necessary skills to administer the trust assets and do the investments and everything necessary to keep growing them and protect them for the benefit of the family and the beneficiaries, obviously.
Sure, absolutely. But I mean, all these structures, obviously, they don't come for free, right?
Of course.
So, and there's different levels of trust, and certain people just need it for their assets, some people for their businesses.
Yep.
I mean, approximately, what kind of net wealth level do you think people should be looking at when it comes to the structures that you set up?
So, I mean, look, I think there's a few different categories, right? So we have one trust foundation product that's what I would call it's called the Eternum Trust and Foundation, and it's what I would say is a sort of semi-custom trust or foundation, right? So it's more or less you have a few different options that you can choose from in terms of customization, and then that's it. And that's probably going to be good enough for 80% of the people, right? It's not too complex, but it's going to provide most people with what they need. And I would say that starts to make sense once you have about $1 million in liquid assets. Then that already starts to make sense, right? Because it's not so expensive to set up. And the administration costs on an ongoing basis are manageable. Once you hit about, I would say, 10 million, then you probably want to start looking at something that's now, even if you're at 10 million, if you don't have any, very specific criteria that you want built into the trust or foundation, the semi-custom option is going to be good. But generally around 10 million, people want to start putting in some very specific provisions into the trust or foundation. And then you want to look at sort of setting up a very customized trust or foundation specific for your needs and your family's needs. And once you hit about 25, 30 million, then you're looking at sort of comprehensive multinational estate planning, right? So that's when we get hired to look at somebody who says, hey, look, these are my assets that I have worldwide. These are the citizenships and nationalities of my family. Design a structure to own all this stuff, a trust and foundation behind it that's going to be multi-generational and that's going to serve these specific purposes.
Absolutely, that makes a lot of sense. And what was interesting is, I'm guessing as well, even though it's a bit of a thorny issue, for some people, if they're worried about lawsuits, I guess in reality, that is actually one of the many things that maybe prompts them to get these structures out. Now, I understand that obviously it depends on the jurisdiction. Obviously, in certain countries, there's more litigation than others, including the United States,
Sure.
right? But I'm guessing that is one reason, actually, why people get out these structures as well. They want to separate themselves from their assets, right?
Well, I think that's absolutely right, and I think it goes beyond lawsuits, right? I mean, a lot of times when you talk about wealthy people, even not so wealthy people, they want to sign prenuptial agreements before they get married, right? But as we've seen in many court cases in the news and stuff like that, prenuptial agreements are not always the strongest. They can be broken for different reasons. I usually advise my clients to put their assets into a trust before they get married. Then they don't even need to talk about the prenuptial agreement in a lot of cases, right? Because the assets are in a trust, they're protected. And you're not only protecting the assets from lawsuits, from your business or from whatever, but you're also protecting it from potential lawsuits of your heirs, right? I mean, if you have kids that are a little bit older and they're beneficiaries of this, and if you were to die and they were to receive these assets outright, if they get sued, the assets are at risk. If they get divorced, the assets are at risk. But if the assets are held within a trust or foundation structure, you're also protecting the beneficiaries insofar as if they get sued, the assets in the trust or foundation can't be accessed to settle that lawsuit because they don't belong to them. And likewise, if they get divorced, the assets in the trust or foundation aren't going to be available.
Absolutely, and that's a key thing as well, because obviously some wealthy families maybe are worried about the marriage partners of their children. Sounds a bit, I guess, perturbing for some people, but it's just the reality of the world, right? So that makes a lot of sense. Now, I presume then you are just on the tax side, right? So you do work in conjunction, presumably, with private bankers, different lawyers, companies like our own. But you yourself, of course, I guess you don't ever choose the assets unless it's from a pure tax point of view. You might give your opinions and say this is a PFIC or don't do this, but you don't actually manage the assets. You more manage the structure. Is that correct?
That's correct. So I'm focused on the tax and structuring side, right? So mainly I'm focused on designing the trusts and foundations, designing the holding structures, and then obviously advising on what the tax consequences are on those and trying to make whatever I set up for my client as tax efficient as possible. I don't give investment advice at all. A lot of times clients will come to me and say, hey, I'm thinking about making this investment. How does this going to be taxed, or how do I need to report this or whatever? And I'm happy to advise on that. But other than that, I don't give any sort of advice in terms of investments.
Sure. Now, you mentioned foundations as well as trusts. Now, what would you say are the key differences, and who should consider trusts and who should consider foundations?
So I think the easiest way to describe the difference between a trust and a foundation, I'll try to give a brief background. So a trust is actually not even a legal entity, as many people don't know this. A trust is essentially a contract between the settlor, the person who's setting it up, and the trustee, the person who's going to be managing or holding and managing the wealth for the benefit of the beneficiaries. What is a little bit what I don't like about trust, or makes trust a little bit complicated, is you need the actual trust agreement. You always need a third-party trustee. And so that means you either have to hire a professional trustee or you have to set up a private trust company. But you always need this third-party trustee. So it's always sort of a two-party thing, right? You have the trust, and then you have the trustee of the trust. And trusts can't even actually own anything in their own names. Everything has to be owned in the name of the trustee, because the trust is a contract. And trusts are a common law construct, right? So trusts are something that come out of the common law. In civil law, trusts don't exist. And so in civil law, there's this concept of a foundation. And the best way to think of a foundation is a corporation, but instead of shareholders, you have beneficiaries, right? And so to me, I much prefer foundations. In most circumstances, I'll prefer a foundation over a trust, because it's sort of an all-in-one entity, right? You have a founder that puts the assets into the foundation. You have a board of directors that manages the foundation, and you have the beneficiaries that benefit from the foundation. the one thing that trusts do offer as a benefit over foundations is privacy, because like a corporation, a foundation is an incorporated entity. So, obviously this isn't something that's registered with the government. You have to disclose, who the beneficiaries are, who the founder is, the board of directors. So there's certain information that is provided to the government. Whereas with a trust, at least here in the DIFC and in most jurisdictions, because it's a contract, it doesn't need to be registered. None of the people involved with it need to be disclosed anywhere. So it does offer additional privacy as opposed to a foundation. But I think most of the information that's provided to the government with respect to a foundation isn't public. And so to me, in most cases, I would still go with a foundation over a trust, even though it's a little less private, just because it's a lot easier to administer, in my opinion, and more cost effective. But if privacy is really a concern, then I think a trust is the way to go.
Sure. And how can people reach out to you if they want to use your services?
The easiest way to reach out to me is via our website at esquiregroup.com.
Well, fantastic. Thanks for coming in. And everyone else, like, share, and subscribe. And until next time, have a great day.